Let's bring on board then Paul Schulte, CEO and Chairman at Schulte Research. He joins us live from Hong Kong. Paul, hi, morning. Good to have you on the show. Firstly, your takeaways from the Fed commentary yesterday, and rather dovish, you'd have to say.
Yes, three things. Number one, we look at what's going on with equities, we look at what's going on in fixed income and with the dollar. And in the case of equities, we had a equity rally. In the case of the dollar, we had a flat dollar. In the case of the 10-year bond, we had a flat bond. And so when you take into consideration not what all the talking heads are saying, but what the markets are saying, the markets are saying this is good, this is appropriate, this is where we should be. The bond market didn't throw a tantrum. The dollar did not throw a tantrum. So I think, generally speaking, asset prices agreed with, Ms. Yellen saying that, there's weakness in the labor market, there's weakness in prices, there's a deflationary element. I always want to tell people about the Minnesota Fed governor, the Indian guy who has been a lone voice in the wilderness saying, we need to pay attention to what's going on with the deflationary impact on labor and prices from companies like Amazon and Alibaba and Tencent and Google and Microsoft. There's a lot of deflationary pressure out there on labor and prices and the effect that these massive companies are having on our ability to buy cheaper and cheaper goods at lower and lower prices, which damages more and more jobs. And, this is something which is a really powerful phenomenon in the background that I'm sure the Fed is taking into consideration.
What really affects this part of the world, when I say this part of the world, emerging markets, is the Fed balance sheet. Now, the Fed monthly buyback program has come down from 65 to 35, and no one seems to be taking notice of that.
Well, that's right. And so we continue to have an expanding balance sheet of the Federal Reserve, and the Federal Reserve's balance sheet is going to be expanding again way until very likely into the end of the year. And don't forget, the Federal Reserve can reserve the right to, restart the whole program if it sees it appropriate. Don't forget, 20% of homes in America are still underwater in terms of negative equity. And we still have, the vast swath of American homes that are somewhere between, 15 and 20% below their prices of 2007. So there's a lot of damage in the economy, which is still, in effect from the downturn in 2007. And so even if we get to a point where there's a sort of a net zero effect on the balance sheet of the Federal Reserve, we still need lower rates for an awful long time.
Paul, the fact that the world's biggest economy is making a decent comeback, inflation is not running high, and the Fed is still committed to follow a low interest rate regime. What does that mean? Are they committed to follow a highly accommodative monetary policy?
I think that is, well, I wouldn't say highly accommodative because the deficits are shrinking super fast in the U.S., which is a very good sign, very necessary. So in that sense, the fiscal stimulus is diminishing, very rapidly. So we're still going to have that monetary stimulus, holding in place for some time to come. And as I mentioned in my last time I was on the show, being very positive on the U.S. banks, U.S. banks' leverage ratios are the lowest in the world, number one. Number two, the loan-to-deposit ratio for the U.S. banks is one of the lowest in the world. So the U.S. banks are the least leveraged and the most liquid banking system globally. More liquid than the U.K. banks, the German banks, anything in the West, and anything in Asia, or anything in the emerging world. It's the most liquid financial system in the world right now.
Paul, what's the view then on the ongoing tensions in Iraq right now, and what's the fear? If indeed the situation were to escalate, do you think the ramifications for global equities are going to be rather deep?
Well, yeah, I think one of the reasons why the Fed is also fairly accommodative is I think the Federal Reserve is aware how wobbly the world is, right? We have a Brazil, which is very wobbly. China is sort of getting its sea legs again, but China's been wobbly for a year. And there's all this like hyper, over the top discussion, as I've been, making it very clear. I think a lot of the discussion on China has been histrionic and irresponsible. The view that China is going to fall into the sea any minute now is a reckless view in my view. I think they know what they're doing. So you have, a sense of concern about China, a concern about Brazil, concern about India, concern about, Germany and the periphery of Europe. There's a lot of things to worry about. And now we have this ongoing instability, which is spreading into Iraq, Iran, Syria, Lebanon. And that's, another problem. I had a meeting in Singapore the other day with some people from northern Iraq at lunchtime. And, we need to remember, something that's so absurd about Iraq and the Middle East. And that was, there was a French guy and a British guy 80 years ago who were bureaucrats. And they just said, we're going to draw a line in the Middle East, and it's going to be on top of the J in Jerusalem, and it's going to go all the way to the M in Mosul. And they just drew a line. That's been the Middle East for 100 years. And never mind that the line was arbitrary and silly, but that we're still abiding by it. The point I want to make to you is it's about time for a partition. I think there's more and more discussion of partitioning Iraq and letting it become two countries, like Czechoslovakia, where there was a good solution, like, the Sudan, where there was a good solution, and where you can have two separate countries. I think there's a greater understanding and a greater acceptance that that's a legitimate way out to avoid an extremely bloody, sectarian, religious civil war. I think there's more and more discussion as that being a legitimate way out of the problem. And that's very positive.
Well, Paul, for the moment, no one wants a war, and global leaders, I think they did a great job on how they handle Ukraine and Syria. But my question to you on Iraq is that, is Iraq more like a storm in the teacup? Because even though Iraq has the 5th largest reserve of global oil, currently the contribution from Iraq to the global oil market is just 4%.
That's right, number one. And number two, these facilities that have been taken are for domestic production anyway. And so I think that is very much appreciated by the community. And I think that's why, the equity market is sort of brushing this off. Furthermore, it's clear that if the U.S. has a rapprochement with Iran, that Iran has an extra 5 million barrels a day that can come online. And, one of the issues here is, the enemy of my enemy is my friend. And so suddenly, the mess in Iraq could cause the U.S. and Iran to have a little bit more of a rapprochement and to allow that oil to come on the market. So there is 5 million barrels a day of sidelined oil from Iran that can come on the market. And so I think that's why interest rates, currencies, and equity markets all together are all giving us a great big yawn so far about the problems in Mosul.